Most ranchers know their cow numbers, their rainfall, and their hay inventory down to the bale. But when it comes to books, the real metrics that tell you if you're making money, things can get a little fuzzy and pretty fast. Today, we are cutting straight through that. Three financial numbers every producer should track, what they actually tell you, and how you can use them to make better business decisions, not just fill out your tax forms at the end of the year. First, your cost of production per cow or per hundredweight. Every business is going to do it different. Pick one that works best for you and your operation. This is the foundation. If you don't know what it costs you to produce a pound of weaned calf or finished beef, you are managing blind. Oklahoma State and Kansas State Extension called this the single best indicator of long-term profitability. Here's the formula. Take your total annual operating cost, things like your feed, labor, fuel, vet bill, pasture leases, land cost, depreciation, interest, and everything else that goes into this, and divide by pounds of calves weaned or sold. Most commercial cow-calf operations land between $1.20 and $1.80 per pound of weaned calf, but it varies widely by region and feeding system. Tracking it over time shows your trends. Are you getting more efficient or just getting lucky with the markets? When you know your true cost of production, you stop chasing prices and you start managing margins. The second metric is your operating expense ratio, sometimes called your efficiency ratio. It's simply total operating expenses divided by gross ranch income. The University of Nebraska benchmarks suggest that top-performing beef operations keep this number below 75%. That means for every dollar that you bring in, you're spending 75 cents or less to make it. Anything higher, and your margin for error gets razor thin. This ratio tells you how resilient your operation is to price swings. If calf prices drop 10%, can you still cover costs? It's not a one-time number. It's something you track year to year to see if rising input costs are quietly eating into your margins. The third one, and the one lenders care about the most, is your debt service coverage ratio, or DSCR. It measures how easily your operation can cover debt payments with your current income. The formula is simple. Your net operating income divided by annual loan principal and interest payment. A DSCR above 1.25 means you're generating 25% more cash than your debt requires, which is a very healthy buffer. Below 1% and you are borrowing money to make payments. This number matters because it shows whether growth is sustainable. Expanding the herd or buying land is only smart if your cash flow can handle the debt load in a bad year, not just a good one. So, what do you do with these numbers once you have them? Start by benchmarking. Compare your cost of production and expense ratio to other producers in your region. Most land-grant universities publish annual cow-calf budgets. Then use the trends to guide decisions. If your cost per pound is creeping up, look at feed efficiency or stocking rates. If your expense ratio is high, maybe it's time to cut variable cost or delay equipment upgrades. And if your debt ratio is tight, rework payments or slow expansion until cash flow stabilizes. These aren't accounting metrics, they are management tools for your operation. So, here's the takeaway. Knowing these three numbers, cost of production, expense ratio, and debt coverage, gives you control. Markets change, the weather changes, but these numbers let you see exactly where your operation stands and what levers to pull in order to stay profitable. You don't need your CPA on the phone to figure them out, just good records and a calculator. Because when you run your ranch like a business, not just an operation, you're already ahead of half of the industry. This is the Cattle USA Daily Podcast. I'm your host, Lauren Moylan. Thank you for tuning in to another episode. We will see you all next time.